What's going on, Bob? How are good? How are you? Good to see you again. It's been a little while since we spoke last. Last time we spoke, it was before the holiday weekend, the 4th of July. How was your 4th of July?
Yeah, it's hard to believe, man. We are on the back half of 2023. Is that crazy or what?
You know, I, it is crazy. It went by so fast. It really did. It went by very quickly. Um, Lots have happened this first half, and I see a lot's going to happen in the second half of this year as well. It's been some crazy stuff going on out there. But last time we spoke, we were talking about some leverage, and I don't even remember what the heck we were talking about. Man, we got to like probably do this more often because my brain starts to fade away in what we're talking about and stuff. But I know you want to talk a little bit more about leverage, and that's something we won't talk
Yeah.
about enough.
Yeah, well, this is where the our producer will go in and edit and put in what you
Yeah.
said a couple weeks ago, kind of flashback, kind of like the old Wayne's World movie where we'll just kind of and flashback to when Rob, he'll have to search hard for some words of wisdom, but I'm sure there was one in there somewhere.
Somewhere.
No, I think, I wanted to pick back up because we had spent, a time or two talking about, what is the big issue and what's the top concern and what are people facing? And we've kind of settled on the theme of whether you want to call it leverage or deleveraging, how people have a lot of their capital stack leveraged.
Yeah.
And while there's upsides to that in certain market conditions, in other market conditions, such as the one we're in now and have been in lately, we were talking a minute ago, you can have perfectly fine performing debt from a cash flow perspective, but you could still have your credit facility calling those loans due or wanting you to get them off of their line, and you need to deleverage. And what do? Obviously, it helps us. It gives us an opportunity to buy some assets. And, you can quote unquote call them distressed if they're, maybe they matured or maybe they're coming due and the line's not going to be renewed, or the bank wants them to pay down because the LTVs are now higher than they anticipated. But I don't know about you, but our trade desk, we are seeing a lot more hard money loans, fix and flip loans, folks that have, all right, maybe they pay a week late, but they're not 30 days or anything. But they're like, hey, my bank is telling me I need to get these off and probably will need a new strategy on future capital deals. So I'm excited about that. What are you seeing?
I agree. I do. As you know, I do some consulting and some training. We were just talking about this in one of my sessions yesterday about looking at some of this product that's trading, and I'm always, I always look at this stuff as nobody ever, sells a deal. Everybody sells their garbage. You got to turn it into a deal, and a lot of how we do that, and you and I and everybody in this business is by buying these at enough of a discount to make it worthwhile, so it can be attractive enough. Everything has got to be priced properly based on the risk, but nobody really goes out there and puts their gems out on the market. Everybody puts their garbage out on the market typically. But now what you're seeing is, you're right, things are coming on the market for other reasons now. And I was having this conversation yesterday. It may be some sort of private equity fund that had a 7-year lifespan, let's say. Now it's coming to maturity and they got to wind down. And for no other reason but to do distributions to their investors, they have to liquidate and put out their assets out at the marketplace. Or other things that I've seen happening now too is, a couple of banks going through a couple of mergers on the commercial side, and they acquire some of these loans through the mergers, and it just doesn't meet their mandate of what they're allowed to have on their books. They want to put them out on the market, so it doesn't necessarily mean that they're garbage either. There's just maybe a misplace or just timing of other things that are going on, and so yes, I'm seeing now more that some of the stuff that's coming out of the market is got some quality to it. It still has to be priced properly, but and you've heard me say it before too, that I think what we're going to go through this time is we're going to see more of a credit crunch on the commercial side, and you're going to see, and the typical stuff. You'll see the office space, retail, and some of that commercial sides really take a bigger hit. But it's going to put scare into the marketplace, into the banks, and they're going to pull back on credit. And just like you're saying, they're going to start pulling back some of their warehouse lines, get the stuff off the lines. Doesn't necessarily mean that these assets are garbage. So there's going to be a ton of opportunity of things happening where you're going to see some assets come here that are going to be some really good opportunities. I'm totally excited about it. And so right up what you're saying with the hard money loans that you're seeing, right in line, I think you're going to see a lot of the multifamily debt, especially in hard money for builders that are building this stuff. I'm seeing those opportunities, particularly here in Charlotte, and look, and everywhere people I'm talking to, people that needed money to go do a build for a multifamily, and they got to get it.
Or the value projects,
right? Stuff, right. And then they got to get to the exit permanent financing, and the permanent financing, messes up all of their financials. And it doesn't make sense, or the terms aren't available anymore. Now they're stuck in these types of.
There's two things. Their exit was to refi out at a low interest rate, which is not the case.
Now, yeah.
And especially even on the fix and flip resi we're talking about, the ARV at the time of origination was X, but a lot of markets have faded. So they either, they're like, you're not going to be able to sell that at 350. The market right now is 310.
Yep.
And they're in that thing at 100% instead of, a 75 LTV, and that's where they're getting squeezed too. It's like, yeah, but it's on the market. It's going to sell in the next 60 days. And they're like, yeah, but it's not going to sell anywhere close to what you said the ARV was going to be.
Yep.
And you're completely tapped out with draws and everything. And now you're sitting there paying interest. And it's like, what do we do? But if you can buy them right, and really it's not about yield because most of these are written at decent interest rates.
Yeah, of course.
It is about exposure. Like, where do you want to be on that property? Are you fine at being in that loan at par based on what the value is now? Or do you need to buy it at a discount so that your investment to value is where you feel more comfortable? And that's where the whole discount, most people say, hey, it's written at 12, I should get par.
Yeah.
Because but if I get that property back, I'm in at a 110 because it's worth, you owe more than it's worth now.
Yeah.
So
and even that we were doing some modeling this week. I actually shaved. I put on some nice clothes. No, different model. Financial modeling, not the model that you're thinking of. I was doing some modeling.
You would have went broke if it was the other kind of modeling.
If I had a nickel for every time I was asked to be a model, I'd be broke. So we were doing some financial modeling this week, and when you run through the numbers, and you exactly what you said, right? Because I'm sure you saw some of the stuff that went back and forth in the last week or so with one of these trades that had, UPB here, legal balance here, and then it had equity on top of that. And the email went out and said, we expect that we should see par bid for these because the legal balance is higher and you have equity security on top of it. And then some people came back and said, well, why we got to bid at par and stuff? And I'm looking at this, I'm like, why wouldn't you bid at par? If these numbers are real and you're bidding at par and you're still at a 50 or 40 or even a 60 investment to value, loan to value, and you're there, what are you complaining about? I mean, you're either going to get paid or you're going to take that property. I'm sorry?
It's called due diligence.
Yes.
If everything checks out, why wouldn't you pay that? The
exactly.
UPB in that case is irrelevant.
Exactly.
It's what you can collect and what's the property worth and what's the delta between the two.
Exactly right. And so when people just have their mindset, well, I got to buy it at a discount, not necessarily. Because it's not so
you're buying it at a discount. It's a discount of total legal balance or discount of BPO value.
Exactly. And
but they're wrapped around the axle on unpaid principal balance. That's what I learned years ago, and things never change.
Right. But that's not, you got to look at your numbers. You got to look at your money. Some of those deals are actually pretty decent. Again, so long as you're doing your due diligence and if everything checks out, absolutely. But you saw that went back and forth. Why are we paying, even if you pay, we modeled it, even if you paid above par and paid premium on that, some of those numbers still worked. They still worked.
Just for some folks that are looking and saying, these guys, it's Friday afternoon, they've already had a couple cocktails, they don't know what they're talking about. Let me look at it this way. You have a loan that at one time was non-performing, so a loan modification was done. At the time that loan modification was done, part of the principal balance was deferred to the end of the loan. Let's say 50 grand. So the UPB is now 100 instead of 150, but that 50 grand is still owed. Well, they redefault. Well, the UPB now is still $99,000, but you still have that $50,000 that you can collect. So that total legal, not even counting accrued interest and advances, is $149,000. What makes you think you can buy it at a discount off the 99 when you got 50 grand coming to you at foreclosure sale, or when the borrower sells his property because he has it? So it's not voodoo math.
Right.
It's like verifiable deferred amount, accrued interest amount, tax advances, whatever in that state is legally collectible, you got it. So hey, if you guys think you can bid off of UPB, that's just more stuff for me to bid at. And
Absolutely. Absolutely. So a couple of, some good news that I've, looked at and heard of as well. And I actually had this conversation with my team this morning. We're at a time, at this time around, yes, we're going to see a lot of good product come on the market. Again, maybe even paying a premium above par may work as well. If you got to do your numbers and know your numbers. But the good thing, I've always said all these years that I've been doing this, the only thing that I can't provide in one of these solutions is the income on the borrower side. If a borrower can provide income, I can, give discounts, structure the payment, the term. I can do anything with that loan to make it work. I just can't provide the other side of that equation, which is the income, the payments that come in. And so that's always been, the unsolvable from our side, in this industry. But you look at the numbers and where we are today, economy-wise, or in the economy, jobs and wages are up, and they're solid. So that part of the equation in our business is solved. So that's why it's going to be an even better time, because as we get these things and you have some buyers that don't know how to price their numbers, that means it's going to be more for us to pick up. And even, again, whether we pay par, even above that, we want to do modifications. The one piece of the puzzle we can never solve, we're going into this round with it being solved already. So that means workouts are going to happen even quicker, even better. And I'm excited about that too, having the job situation in better this time around than we had, the 10 years ago that we were doing this. So I'm excited about that too. That was good news. And look, I still think that we're going to see some pain. There's still going to be some job losses. There's going to be some unemployment going on. But I think people are going to be able to pick up new jobs a little quicker this time around because the opportunities are there. I think as a country, we're moving a lot of manufacturing back to the homeland here, creating new jobs. And so a lot of the jobs that were sent overseas are going to be coming back here. And so that's good. That's promising for, our missions of what we're trying to do here and keeping people in their homes. Because again, that part of that we couldn't solve the equation is already being taken care of. So I'm excited about this.
Yeah. And as long as we create, and we being the private and public sectors, meaning the government as well, an environment for small business owners to continue to grow, then employment, you have a team. Okay, well, I didn't know you had a team, of any. All right, so maybe it's 3 people. Maybe next year is 5. Maybe it's 8, whatever, right? And you're building that team, whether it's, on staff W-2, or we have a contract person that we bring in as part of our team, and so forth. But we're growing as well. We're trying to balance, all right, well, how do we manage the growth that we're seeing in our pipeline, right, with the overhead? Do we hire somebody permanently as a team member, or do we outsource that through a contract labor relationship where, like, we have a fractional CFO, right? We couldn't afford, quote unquote, to go out and hire and spend all you need for in salary benefits or whatever for a full-time chief financial officer. But you can get a fractional CFO for, however much a month, let's just say $6,000 a month. And you can get all your CFO responsibilities, project, all the stuff you would get from your CFO and not have that overhead. And that goes all the way to chief marketing officer, all the way down the line that you can do that. So there's ways to grow your business without having to just totally dollar for dollar, whatever you bring in a revenue, you're spending in expenses, by throwing headcount at it.
Yep.
So,
and I think
I wanted to talk about, you had mentioned something earlier that I thought was a good point. You kind of glossed over. It's like, on the commercial side, everybody's like, oh, office buildings are going to blow up. Nobody's going back to work and they want to cut their lease. They don't need a big footprint. And then you kind of touched on multifamily. And, everybody's got a job. Everything is going to be great. But, every pro forma that was built on that is escalating rents. They're always going to go up. We're going to have more cash flow. That's not the case. And I think, nobody wants to, I think people have their head in the sand about multifamily, like, oh, it's really going to be commercial as far as offices and stuff like that. It's not going to be multifamily. I think they're wrong. And, maybe the A grade, the super prime properties are, built by multi-million-dollar hedge funds. Maybe they'll be fine. But that B and C class stuff, you just can't say, hey, guess what? Your rent's going up.
Yeah, I agree. I agree with you. And that goes back to what we've been talking about, that how do you solve for that then? Then you just got to, again, it's the balance sheet. So if you don't have the income on the one side, then you got to lower down your liabilities and deleverage and take down the debt. You got to just lower the debt side so you can make that balance sheet into balance. And that's
on the retail properties too.
Yeah, exactly.
Let me give you this a real life example. So I go to this local store every Saturday, take my dog there, get treats, all that good stuff. So I know the owner. I've known her for a dozen years. I was talking to her yesterday, and it was like, man, is your air conditioner working? Because, you asked that because it was hot inside and it's 100 degrees. So even if it's cranking up, it doesn't always cool off. Right?
Sure.
She said, well, I think it's on my last leg. And I just hope it doesn't go out. And I'm like, well, why is that? No, won't your landlord fix it? And he's like, well, in my lease, I've got to fix it myself. I was like, really? She goes, yeah, it's going to cost $26,000. I'm like, what? And this is a small place. I don't want to guess, but let's say less than a couple thousand square feet. Well, it's in a strip center. They got to hire a crane to put this thing on the roof.
Oof, yeah.
And that's the reason why it's going to cost so much. And she goes, but the good news is my lease is getting ready to run out. And I'm in the middle of renegotiating, right? I just hope it doesn't break before that. And I was like, okay. And we were talking, and, she'd been there, like I said, a long time. Well, there's some vacancies nearby. And she had her tenant broker check around. New empty spaces adjacent to hers is $10 less a square foot than they want to re-up her at. I'm like, no, do not do that. Yeah. And I'm like, you're in the position. Well, I don't want to move. I know you don't want to move, but you need your air fixed, and you're not paying $10 more than market value, or else they're going to be stuck there with another. I said, who's been next door to you? A hamburger joint, a milkshake place, a barbershop, all this different stuff. And she's like, yeah, I know. I've been here longer than anybody except for FedEx, who's right next door on one side. So it just shows you that's one person in one Dallas suburb. And I'm like, if this is going on in a lot of places, the tenants have some leverage.
Absolutely.
And that's going to decrease the cash flow, in turn, the NOI on these income producing properties. And the banks are going to get squeezed because, whoever the landlord is on that, they got debt and they're trying to service their debt too.
And don't think the banks don't know this, right? Because they hire, the quants, the analysts, and get all the data. They get all that information. They know what's going on. That's why they're going to pull back. When the time comes, and I honestly, I think it's going to be before the end of the year, you're going to see a couple more banking defaults. I think we're going to see a couple more interest rates rises. We're going to see the banks pull a lot of stuff, and we're starting to see it already. But yes, this is all part of the deleveraging process. And look, if it's done the right way, where it's just not by just pulling the rug out from the businesses and the people, and if the rug is just not pulled out and it's actually done in a formulaic, in a mitigated, in a winding down type of process, as opposed to just rip the Band-Aid right off. This can be done, and it can work out very nicely for tenants, landlords, and even homeowners who are going to be in the midst of all this. So it's again, this time we're going into this downturn from the credit point of view. It's very different from 10 years ago when it was a subprime crisis. Completely different. This, I think, is going to take a little more workarounds, work-throughs, and workouts, which can have a lot more moving parts to it. But I think, again, people can do very well in this business, in our industry. Again, if they're not just looking at, I'm going to buy a discount or UPB. I mean, let's go back to that for a second as well, right? The discount to UPB. Here's the simple part of it, right? We make money on the spread, and there's the value, and then there's the discount, and that creates our spread. So if our value goes up, it creates our spread. So what's the difference if we're not paying a discount?
Right.
So if we're not paying that discount and that spread is created because valuations went up, okay, you're still okay. It doesn't always have to be the spread is made on the discount. You got to look at the big picture here and what it is that you're actually buying and what you're buying for. So I just want to make that point too, that you can pay par, you can pay premium above par, and it could still work if the valuations are there. Again, after, like I said, after doing due diligence. But yeah, again, like I said, I'm excited about what's coming and what we're already starting to see. I'm sure you've seen it too. This week, how many announcements we got from the one trade desk, 200 or 300, and another 100 that came out, and another 90 something that came out. Haven't seen that in a while too. It's starting to come.
Yeah, it'll be interesting to get some color on that trade. Yeah. Number one, pricing expectations. Number two, does anything actually trade?
Well, yeah.
Because offers are made, offers are accepted, due diligence happens, there are fades, there's price adjustments, deals fall apart. So I'm cautiously looking at that opportunity, but I'm not. I'm more of, I'm going to wait for the fallout, and then when all the dust settles and you really want to sell these loans, you call me. Because right now, if somebody's got 300 loans and they're like, yeah, I'm willing to take loan level pricing on all of them, I get it. I don't like all or nothing trades, but if you're going to get 300 or offers on 300 assets, first of all, it's
the overhead of it's ridiculous, the overhead and how much manpower you got to put into just trying to close that.
Yeah. So, I would have went, hey, $1 million tranches minimum. If you'll take at least $1 million, we'll do some deals together. But I'm sure you can cherry pick. If you can't find one out of 300, you probably don't need to be in a business. But I don't know, Rob. I don't like chasing stuff everybody else is chasing.
I agree. One of the things that we talk about when I'm teaching some of these people that come to me, I have a specific formula that I use, a discipline that I use, and one of it has to do with the velocity of money in the formula and how much time and utility and all that stuff and everything. And once that's defined, whatever comes out into the market, it either fits in your buy box based on what you're trying to do or not. And we did a couple of people that I've been working with, they had their own trades come in. I got this tape, I got that tape. And we went through some due diligence, and when we looked at some of these trades going through, we talked exactly about that. How many of these you really want to pick up? How deep do you want to dive into some of these with title, with BPOs? How much time do you want to put into versus deploying your capital. Okay, where's the trade-off? If we get it at enough of a discount and buy it in bulk, do we need to make sure that every T is dotted? I mean, every T is crossed and every I is dotted? Not necessarily. That's why you're buying it at a discount. There are certain things, obviously, you always have to do with chain of title, perfection, and all that other stuff. But you do the basics. Get enough of a discount, and the rest of the stuff you can figure out as you go because you have enough. As long as it's enforceable, right? The enforceability is really what you want to get at. If you have an enforceable lien, perfected lien, much more beyond that, that's why I look at certain layers. What you have to have, what you probably should have, and then this is okay whether you have it or not. But then my pricing goes accordingly. If you're going to get that much of a discount, then just give me absolutely what I need to have for perfection of lien and stuff. If we want to go more and more deeper and prices getting higher, you trade off your time and effort in this stuff. And as long as you can put that in place, it's easier to buy these things. Again, I agree with you. Doing the loan level stuff on 300, it's not worth the time and the effort that you got to do.
Yeah.
The bulk trades are much better.
Around here, when is enough?
Yeah.
Right. So when do you have enough information that you can, you can make sure you're protected, but you're ready to go? First of all, for the most part, we're buying at a discount. There's a reason for that.
Right.
There's a reason somebody else didn't pay par or more for that asset. And, it could be document deficiency. It could be value fade. It could be whatever. But to your point, as long as you have an enforceable lien in the position you're pricing it for, right? We focus on first liens. If I get an enforceable first lien and I'm pricing it accordingly to where, all right, I don't have the HUD one from 20 years ago, so I can't securitize this loan. Okay, I'm not paying 102 for it anyway. That's why it didn't get securitized. Right? Or if I'm buying a seller finance deal and they happen to use a note that they found at Office Depot instead of the Fannie Freddie standard form, as long as Rob signed it and promised to pay Bob back on a timely basis, that's all we need. So,
yeah, I agree, and that's okay. It's fun. Not everybody can be as great as you in doing this. We all strive to be as great as you, Bob. But that's a good point, though, right? When is enough? Because you can go down these rabbit holes with this stuff on and on and on and on. I have one that I just gave to Erin that we were on with last time. I gave her team one that I have in Massachusetts. But I haven't touched this loan in 5 years because, again, I bought it out of a pool. I think we did that trade back in 2015. We did that trade. I bought a whole bunch of these loans, and this is the last. Maybe I got 2 or 3 more left in that tranche. But this one in Massachusetts, I hadn't touched in 3 or 4 years because we made money in the entire pool already. So anything I do with that is just gravy. I remember originally when we got it, there was contact with the borrower, and they were going to pay us off. We were negotiating a discount to pay off, and then they just got resistant and combative. And I was like, yeah, okay. At some point, you're going to need to sell that property, refinance it, or do something. And at some point, you're going to need me to sign off on a satisfaction of mortgage. I'm not going to put any more time or effort into this. I'll capture appreciation over time. And at some point, you'll need me to sign the satisfaction. At that point, I'll get paid then. I didn't want to put my time and effort into that because my time and effort into everything else is where we ended up making the money. And so it's okay. I don't even remember. There was some issue with it where she was going to come back, and I think she had maybe some lender liability claims, some predatory lending claims. Look, let's talk about that for a second. Okay? You don't hear this anywhere as well. Holder in due course. Under the UCC and being a holder in due course. Okay, so let's back up a second. So some of these loans have liability attached to them from the point of origination. A broker or a mortgage banker may or may not have committed fraud on the origination, which gives rise to some predatory lending claims, and which would give some offsets and some claims to the homeowner where they can offset what's owed because of the practices that were employed when originating the note. Okay, fine. But there is this concept of holder in due course, that I am not I am not responsible for the sins of another. If the broker, the originating broker, or the banker, force someone to sign a promissory note for whatever reason, there's always different crazy scenarios that this can happen, and there's liability on the note. As long as I am not aware of any of this when I buy it, that I buy it without awareness of some of the predatory claims or some of the liabilities attached to it, then I'm safe from those claims. Those homeowners may have claims, but it's not going to be against me as the owner of that note. I'm a holder in due course, meaning that I went through proper due diligence to pick up this loan. I have perfected lien interest, and the liability of who lied in the origination and who forced you with a gun to their head in the origination, whenever that happened years ago, your claim is with those people and not with me. I'm still owed the money. I own that note, free and clear of those predatory claims. And so, and that needs to be part of people's due diligence. That if the due diligence is done properly, you get that safe harbor where you are not subject to the predatory lending stuff. And so, going back to what we were talking about pricing this stuff and liability and why these loans come in at a discount and what we're looking for, again, at the same time, people don't look at this when they're doing their due diligence. But again, does it really matter if there's predatory lending in some of these loans when we're picking it up? It matters to the homeowner, absolutely. But as we're doing trades and back and forth, it may or may not matter. If we're picking these up, we're doing the proper due diligence, those claims can't be attached to us when we're going to enforce these liens and do workouts. Because remember, at the same time, when we do these modifications, a lot of these modifications have waiver of claims on the homeowner side. You may have been duped in the origination side. You may have some predatory claims, but as a condition of this modification, whatever claims you may or may not have had get waived. And so we're cleaning up the paper and liability right there. And that's part of why we're buying this at a discount, because we're cleaning up some of that liability if it exists or doesn't exist. But, holder in due course is out there that will protect us if we're doing the due diligence properly and the right way. So I just wanted to bring up that point for a second.
Yeah, no, here's how I look at that. First of all, it's got to pass the life's too short situation, right? I got enough capital to buy deals I want. I don't have to go fight somebody. If it's crystal clear, like you outlined, great. If it's in some state where they got a sympathetic judge and you're going to get the can kicked down the road for 20 more years until you finally win, it's probably okay. But for me, I got better things to do. Right. So I'm not going to mess with it. But if you have patient capital and you can buy it cheap, and you're like, you know what? One day, like you said, which I'm surprised your deal in Massachusetts, they haven't sold that property or tried to refi it in the last 5 years and came across it, but they will. Sooner or later, somebody's going to come and you're going to go, hey, you got a lien on this. You go, man, I charged that loan off 3 years ago, or I wrote it off internally as a loss. Well, we need you to satisfy. I'm going to satisfy it. They owe me $82,000.
Be happy to sign that piece of paper. Just write me the check.
And then at that point, depending on what your cost basis is, you can negotiate whatever you think is fair. And part of being fair is how much cooperation that person gave you over those 5 years.
Exactly right.
So you are the lender, you are the bank, and at that point you can negotiate whatever you want. And, some people, it's free money, you bought the loan, you pay something for it, you've had it. I mean, I'd love for assets that I have written off in my head or on my balance sheet to come back and say, hey, will you take something for them? But you have to look at each case and say, yeah, I'll take something for it. I want X amount to clear that one up.
So that's how I developed my perspective on buying second mortgages. I looked at junior liens this way. All I'm really buying when I buy a mortgage is the authority to sign off on a satisfaction of mortgage so that I can help someone get marketable title so that title can be transferred. At some point, someone's going to need that signature from me. And so
Yep.
I'm buying that authority to sign that piece of paper, which is very powerful. So if I'm going to have the same, I'm really buying the same thing as the first lien holder, I looked at it as an option. Why don't I get a seat at the same table in the same title report with less money, having the same power as senior liens in front of me? Now, listen, there's other risks of being foreclosed out and other due diligence you got to do, but I'm looking at it as if I'm just going to deploy capital in a strategy, would I go to put my money in the first or the second? I like the second better because it's almost like an option play as opposed to buying the stock. I'll buy an option and let's see, I could put less money into a deal and have the same power, and I can spread my money across more of those liens, buy more units, get more diversified, and have the same power in writing satisfactions and signing satisfactions. And I don't have to then worry about taxes, insurance, and impounds and funding the impounds, and then putting more capital into making sure the impounds are taken care of. Right? So
you need to make sure they're being taken care of. You just don't have to be the one doing the advancing.
Exactly.
You sure don't want to lose your position because it went to tax sale or the insurance went there.
But when I get noticed that there's issues with impounds or tax and stuff, and I get noticed, at that point I can take care of it, right? So at that point I can deploy more capital. I don't have to do it up front. If senior lien position is going to take care of that for me, thanks, big brother. Thanks for taking care of your lien position and mine at the same time. Thanks for having me covered. Thanks for doing that forced placed insurance and taking care of all that stuff for me. I appreciate that. Okay. And so when they go refi or they go sell the house or whatever, I just get paid. It's like you got paid, but I had to do less work with less money. And so time value of money and deploying the capital and having my capital diversified over multiple units, to me, that's where I went in my philosophy of why I wanted to buy seconds. I do both. I do first, seconds, commercial. So you want to diversify and all of it. But I wasn't a big fan of seconds in the beginning when I looked at it. And then I finally just thought it through. And I said, if I look at it as an option, options are pretty good. It's a good play. And I looked at it from the point of view of just signing the satisfaction. Yeah, I'm good. We can go buy these.
Yeah, I think the key is the diversification factor you mentioned.
Yeah.
Right? Whether it's first, seconds, performing, non-performing, resi, commercial, whichever one, I like a blend of all that.
Yeah, absolutely.
Because if you get stuck, and same thing with demographic markets, or geographic markets. If you're just going to say, I'm buying MPL loans in New York, well, good luck.
Yeah.
First lien, resi, New York, well, that's an awful skinny scope of business. Now, there's tons of it out there, but, pretty much along the lines of all your eggs in one basket. So I like being as diversified as I can from an asset class.
You have to.
And from a geographic class. And I like dealing in markets that I like. I don't need headaches. If I don't want to deal in the middle of nowhere, Pennsylvania, then I'm not going to buy it.
Yeah.
I'd rather buy in Charlotte, North Carolina, or Dallas, Texas.
No, you can't come here. Can't come.
You may not get in that particular area, but I can go to some suburb. I don't know.
No, you're not allowed. You got to stay in Texas.
Yeah.
But
anyway,
I agree with you with the diversification, because going back to what we did in Massachusetts, that's a long term. That's 7 years now. I've sat on that lien, and at some point they'll sell. We're going to now do a maturity default so I can protect and preserve the statute of limitations. I may be out of the statute of limitations with payment default, but not out of maturity default. So we may do we're going to probably bring up a foreclosure now, and hey, you got to pay me.
And that's a good point. I know the purpose of our bantering is not to get into a bunch of legal, mumbo jumbo and all that kind of stuff. But a lot of people get the statute of limitation, and they're thinking, well, there hadn't been a payment made in so long, and I can't enforce that because the statute of limitations expired. But there is a difference between the payment part and the enforceable lien part, meaning, one day they're going to sell or refi that property, and you have a lien that's going to be paid off, and that's at a minimum what you want to make sure you keep in place.
Absolutely. And that's why I said, what you're really buying is the signing off of a satisfaction. Somebody's going to need you to clear title one day. The only difference is, are we going to force that process, or are the homeowner going to force that process? And when we're outside the statute of limitations, that just means that we can't start that process. That's all that means. That just means we're going to have to wait for the homeowner to do it. At some point, title's going to have to be transferred and you'll get the call. And it goes back to the diversification. Right? You have to, if you're going to have some of those that are just going to sit and wait and be patient, that's good. That's fine, because you go back and buying the seconds again. One of the reasons why I like buying the seconds, especially that one in Massachusetts, let's talk about that. So for 7 years, haven't heard from them. But what have they been doing? They've been paying their first. And so if they're paying their first, that means every time they pay their first, I get closer and closer and closer to being the first. Because every time they make a payment, they're whittling down the UPB of the first mortgage in front of me, creating more equity, more security for me on my second. And the closer they get to their zero balance on their first, the closer I get to being next in line and being the first by doing nothing except waiting. And then you have appreciation over time. So by capturing the appreciation and capturing the amortization on the first, I'm becoming more secure with equity by doing nothing and sitting on that lien over time. Now, it becomes a liquidity issue. You're not making money off of it. Then you just got to solve for liquidity. And that's why you got to have performing loans, doing the trades, doing everything else to create the liquidity, because that becomes a problem of liquidity. So if you can solve for liquidity, you can be patient with it. And at some point, it's still accruing interest. So it's not that it's not making money. On the account, it's still growing by doing nothing. And someday I'll collect all of it, but I just don't have the liquidity today.
It's the kind of loan you should have bought in your IRA.
Sure.
Because one day, as long as you're not advancing a bunch of funds or whatever, right, you're just letting it sit there, one day somebody's going to come and have to stroke you a check.
Exactly.
And if it was in your self-directed IRA, all of a sudden that income is going to go right into that. And you're not going to go like, oh, man, I made a lot more than I thought I was going to.
Yep.
What am I going to do? You already got that tax deferred plan by putting it in your IRA. So
this one's inside of our funds. We bought that as a pool. So that's for everybody. We do have a couple of people who have their IRAs in there with us. So they'll get that benefit. Absolutely, they will.
Right, for sure.
Absolutely, they will. But you're absolutely right. That's exactly the type that should go in the IRA. That long-term, set it and forget it. Absolutely.
Yep. As we wrap up, I wanted to mention, because you had touched on opportunities when people are closing out funds. The funds have come to maturity and they're looking at, hey, I've got a bunch of loans and I need to get rid of all of them. Those are the kinds of deals that if you can figure out, I'll take all of them. And there's a small one there. I'll just throw that small one in my IRA. And I'll take these other ones down. Some of those can be some really good fits for kids' IRAs, grandkids' IRAs, health savings accounts, perfectly fine. But nobody wants to buy a $4,000 balance. Well, if they need to sell it to close the fund and I can buy it at 50 cents on the dollar and I can put it in an IRA, why wouldn't I? It's just, So for all you people out there with small balance IRAs, you can be in the no business.
Absolutely.
I mean, there's ways to deploy capital in small amounts. So.
Absolutely. There's plenty of those out there. Absolutely.